talk about a number of things. So for today, what I want to do actually is to, no, not this one. Where is it? So I want to just touch upon a number of topics, especially to do with convertible bonds, just simple convertible bonds. I want to share with you some concepts regarding how hedge funds actually trade convertible bonds, because I think unless you understand that part, okay, a lot of things about CBs, don't really come to you naturally. I want to talk a little bit about call spreads, CB call spreads, and equity swaps, and then we'll come on to Country Garden at the end, okay? And then the last part, I want to just give you a checklist of things that you should pay attention to when you are revising for your midterm exam. Okay? So after you take the midterm next Saturday, Rhodes case material will not be examinable anymore. In fact, there are no more exams for this course because you know very well for Chris Lee, he's just going to quiz you every week on 2 cases, okay? So the logistics are such that, okay, just hold on a second, okay? I'm going to change this. So I'll go over the logistics very quickly. So starting this coming Saturday, Chris Lee will take over, and so his part is worth 50%, and you are going to get quizzes. So there will be total 25% for the quiz. And then there's a group project, which I think you all know about. That is when you do a presentation. And then there's participation and tutorial. He gives a score also for your class participation, as you know. Now, in the next 4 to 5 weeks, so every time you come here, so Chris has already done a couple of cases with you. So the first 2 cases, as you would know, are actually Ant Financial and Amaranth Advisors. Are you all aware of that? Yeah? So if you read the course outline, the 2 cases are this one and this one. Now, so what we're going to do is, so tomorrow, Chris will give you a lecture, a talk, which is not case related, okay? It's an introductory session. So Jan 19 is when you have your midterm. After that, you are free to go, unless you have other classes for that day or other tutorials. We'll come to that in a moment. And January 26th, everybody will take a quiz on Amaranth Advisors and Ant Financial. You are aware of that, right? Everybody will take a quiz on these 2 cases. And there are teams who will do a presentation, okay? And the teams were chosen by randomly assigned this morning, and I actually did that in front of a class, in front of a tutorial. So for class A, Ant Financial basically will be covered by Team 8, and Amaranth will be covered by Team 7. So everyone will take a quiz, but these two teams will actually share with us their findings and their analysis and their presentation, okay? So for the afternoon class, it will be Team B4 covering Ant Financial and Team B1 covering Amaranth. But everybody will take a quiz on the case. Is that okay? Do you understand what's going on? Yeah? Now, maybe you're wondering, where are the cases? Okay. I have actually given out all the cases. I gave out four copies per team. Okay. So I bought 64 copies. We actually paid for the licenses. Every copy is around $4. So we pay for 64 licenses, and I didn't want to print 120 copies. It's not really good for the environment. But I do have some left. I actually got 3 copies. So if anyone wants to have, your 2 minutes already happened. Does anyone not have a copy? So now, actually, this part is just logistics, so I don't have to talk too much. So now you have access to these copies. And so please study it. So when you take the quiz, we expect you to know the case reasonably well. For those teams who are presenting, we expect they will know the case very well, but the other people who are not presenting, okay, you will also be taking a quiz. And then the morning quiz and the afternoon quiz are different, okay, as you can expect. Okay. Now let me now go to. So I want to spend a bit of time discussing with you. So for Chris Lee, so the lecture will start tomorrow, and I'm going to give out cases. So I gave out basically 64 copies today in the morning, and I'm going to do that next week for cases 3 and 4, Harley Davidson and Merrill, and I will tell you next Friday who will be presenting. So actually every team will get 2 weeks, just to be fair, okay? So every team has a 2-week window to prepare their presentation, okay? And then I'll tell you about Morgan Stanley and General Motors after that. This is not happening on Feb 9, okay? So this is Feb 16, and then Feb 23. As you know, we will not have a class on Feb 9, okay? All right. Is everyone okay with that? Now, let me do a quick recap for you on CB, okay? And it is one of my favorite topics because there's a lot you can talk about. Now, first of all, what is a convertible bond? If you look at it and you try to dissect it, convertible bond is simply you buy a bond and the bond comes with a call option, okay? So when you are buying a CB, you are buying two things, a bond and a call on the company's stock. And for that reason, a CB will pay a lower coupon, just the normal CB as we know it, okay? Because you are already getting something else. Okay, so apologies. Okay, and so is everyone okay with that? So let's say you buy a bond, a normal bond issued by a company, a normal corporate 5-year bond, and if normally for a vanilla bond they would pay you, let's say 4%, just a plain vanilla. It's sometimes called a straight bond. Then a CB may well pay you, something substantially less because you are getting something else instead. Okay, so that's the CB. Shall I just give up on this thing? Yeah. Now the call option strike is normally substantially higher than the current stock price. So your current stock price may be 100, and then maybe the CB, the strike, could be like 135. So the conversion doesn't happen unless the stock price goes up a lot. Now I'm talking CBs, let's say in the American market. For the Chinese market, it is actually quite different. One thing that I have noticed over the last few years is that for the Chinese CB market, quite often the strike is very, very close to the spot price. So let's just say 102, okay? Sometimes even the same as the spot price. I have even seen CBs where the strike is less than the spot price, okay? I think that says to me, now it's just a different market, okay? So in China, lots of very interesting deals, but mostly these are very, very close to the spot price. So that means, are you going to get paid a higher or a lower coupon, do you think? Okay, if a company is thinking of issuing a CB, same company, okay? So the first one is 5 years. So the stock price is now 100. So in the first one, they want to issue a CB where the conversion strike may be 135. But in the other one, same tenor, and the share price is the same, but this one is they issue at 100. Now, you have to be able to think about these things in relative terms. 5-year CB, 5-year CB. So let's say you think of a 5-year, a straight bond, STRAIGHT. A straight bond means it's the plain old-fashioned, boring vanilla bond, okay? And let's say for that one, they pay a coupon of, let's just say 4%, okay? Now, what do you think will be the coupon of this bond? First of all, is it more than 4% or less than 4%? less, okay? It has to be less. So let's just say 2.5, okay? Without knowing anything else. Now, I ask you, for this one, would it be less than 4 or more than 4? Less. Is it going to be less than 2.5 or more than 2.5? It has to be even less, right? So maybe 0.5, who knows, right? So it seems to me that in the Chinese market, the issuer's preference is to issue a CB where the strike is actually very close to the spot price. Now, two things will result from that. Number one, the coupon that you pay will be a lot less, okay? Number two, I think the chance of conversion is actually much higher because you are so close, okay? Whereas in the American market, the issuer doesn't always want you to convert. So they want to save a bit of money. So if you issue a bond like this, okay, you save, what have you saved? You save 1.5% on the coupon, wonderful, okay? And if you were able to sell shares, you will sell shares $35 more expensive from an issuer point of view, okay? So the psychology is a little bit different, okay? So I think that's what I would like you to try and appreciate, not just, oh, what is a CB? Oh, it's a bond plus a call, okay? There's more to it when you think deeper about really simple numbers like that, okay? You should also try to understand what is a COCO, and I think you do now because we talked about that. Even a COCO, this morning we were saying that if you have a COCO, now a CB is when you buy a bond and you buy a call option, okay? A COCO is actually when you buy a bond but you sell a put option because the conversion right is not with the investor. The conversion right belongs to the issuer, okay? Strictly speaking, is what I call a knock-in put, okay? It's a barrier option. So you remember that Rose K mentioned there was a deal. I think one example was the Bank of Cyprus. You can find this deal online. Cyprus is a little island near Greece. So they issued a bond called COCO, which is a combination of a convertible bond, these two, plus a knock-in put, okay? If you think about it, for a normal CB, your payoff would be like this. If this is the share price, this is your wealth at maturity, let's just say, okay? So when the share price goes up and goes beyond the strike, you will convert, okay? Now, a COCO, if somebody ever asks you, please draw me the payoff of a COCO as a function of the share price, I guess it would be something like this. So it's okay for a while until something bad is triggered, and then the conversion is forced upon you, and you can lose a lot of money until it completely wipes you out, okay? So that would be a contingent. So this would be the conversion trigger. Conversion trigger. You know, it's worth spending a bit of time to think about COCOs because they have been very popular instruments in the market for, you know, a lot of high net worth individuals, and wealth managers. So the question is, a co, you're really just adding the two. What happens when you add the two together? Well, you get something like this. You get the downside, but you also get the upside. So a co is equal to a CB plus a co. This is the CB part, and this is the co part. All I've done is adding these two diagrams and making it into one diagram. Okay, so I want to just mention that quickly. This is your wealth at maturity. Okay. If you want to know more about this, I have recorded some material that talks in a lot more detail, and that is in another video that you can click on. I'm gonna produce that maybe later on tonight or tomorrow. When you see this timetable here, when there is a hyperlink like this one, when you click on it, it's going to take you to a YouTube channel where that part was recorded. So for this one, I recorded especially some coverage on a green shoe because I know people have problems with that. Okay, and I also recorded for today. I talked in a lot of detail about contractual versus structural subordination, and this one will also be recorded. And of course, I am recording this one now. Okay, so all of these will come with hyperlinks a little later. Okay. Okay, so that's on CBs. Now, this is so I was asking you this anyway. Okay, how is the coupon that you pay related to the various features that you find in a convertible bond? So, for example, when the conversion premium is very high, so your spot price is now 100, but you cannot convert until 150. So that call option isn't really worth a lot of money. So of course I want to have a higher coupon. Okay. Now this one, tenor, it depends. Okay. You buy a CB with a longer tenor, then the option is more expensive. It is true, okay, but then you also take more credit risk. So it can be one way or the other, okay. Dividend yield, when dividend yield is very high, then your coupon will also go up, okay. Stock borrowing costs. Now, I will explain this one a little later on, okay? But I need to explain this one in conjunction with how CBs are actually traded, okay? So the thing is, when you need to borrow a stock, from somebody who will lend it to you, the more they charge, okay, if it's very, very difficult to borrow a stock, then investors will ask for higher coupons as compensation. I will explain in a moment how that hangs together, okay? Now, I I just want to give you some ideas how hedge funds actually trade CBs. And if you want to understand this market, if you want to understand this product, okay, you have to remember that in any market, in any CB market, whether it's in China or Europe or the United States, okay, hedge funds are a major player in CBs, okay? In fact, you know how hedge funds have different style, right? So what do you have? You have long, short, you have global macro, you have event-driven, yeah, event-driven. You have what's sometimes called merger arbitrage, okay? So there are a lot of different hedge fund styles, just almost like different types of martial arts. There is karate, there's taekwondo, there is Wing Chun, okay? There is judo, there is Brazilian Jiu-Jitsu, okay? I don't know, there's kickboxing, okay? So hedge funds, these are all different techniques of beating people up, okay? So hedge funds, there are a lot of different disciplines. There is a type of hedge funds called CB arbitrage, okay? And they are major players. Hedge funds buy a lot of CBs. So if you are a fixed income sales and your specialization is in selling CBs, you better make sure you know all the hedge funds in town, okay? All the CB arbitrage hedge funds. Now, how do they actually trade? How do they invest in CBs? Okay. Now, I guess there are two types of CB investors. Okay, there are what I call dedicated CB funds. Okay, there are funds like that, and they would part of the mutual fund product. Okay, maybe Fidelity or Templeton. So you give them money. They buy the CB and they just sit on it. Okay. Now that's the dedicated CB funds. The other way, or the other big investor, are the hedge funds. Okay. Now, I already told you that if you buy a CB, what risks are you actually running? Well, I'll tell you what risks you're running. So I told you it's a bond. Okay, plus, thank you, a call option, okay? Now, you don't need to be a genius to figure out that in the bond, there is credit risk, okay? And with the call option, you have mainly two exposures, okay? Number one, exposure to the stock price. So when you hold a CB and all else being equal, if the stock price starts jumping up and down, your CB value will also change correspondingly. The second thing is what we call volatility. Option volatility, TILT, okay? Now, it's actually very easy to understand. Let me just fire up a simple option pricer here, and can't be reached because I got the wrong name. Hey. Yeah. Optionpricer.com. We tried all combinations, haven't we? Huh? Thank you. All right, now here is a very, very simple option pricer that I use for demonstration purposes every time. And you have the underlying price, exercise price, which cannot change, days until expiration, well, that's just time ticking away. Interest rate is boring, okay? Dividend yield, don't worry about that for now. But the two things that can really change are underlying price and volatility. Okay, so think of it like that for now. So the problem is, okay, now the underlying price is 100 and a call option, okay, is worth $3. And if the underlying price changes to, let's say, 101, I think the call option price is going to be, who can make an estimation, just approximately, where do you think the call option price will now be? $17? Just give me an estimate. If I change the underlying, that means the spot price, okay? I change the spot price by $1. What happens to the price of the call option? It would increase by more than $1. What makes you think that? I think unless you are dealing with some exotic equity derivative products, normally when the underlying price increases by $1, the option price would increase by less than that. In fact, I'll tell you approximately what would be the increase. Do you see a term there called delta? Thank you. Actually, it's 0.53, okay? So I am guessing that when I hit the calculate button, okay, the price would be approximately 355, somewhere around there, okay? 358, okay, just a little bit out. Now, correspondingly, if this goes to 99, I think the price will now be somewhere around $2.50, okay? $2.51, right? You know, you want to be a good trader or a good manager, you have to be good with estimations, okay? Just roughly where things are. So now that is one way the call option price can change. The other way is if the volatility starts changing. So let's say it was 25 and now suddenly volatility changes to 30. Will your call option price go up or go down? It's going to go up by a lot. Well, not a lot, but it went up a little bit, okay? And that's because the tenor is not long enough. If you make it 365 days, then things really get interesting, okay? So let's say I put 25 here. So now this is a 1 year option. The price is theoretically $11.72. If you change this now to 30, it's going to be very, very sensitive, okay? Can you see that? It's jumped almost $2. Now, ladies and gentlemen, when hedge funds trade CBs, they normally don't want to think about this part, and they certainly don't want to think about this. They are interested in trading this one. The reason they don't want to worry about the stock price, there are already thousands of mutual fund managers out there who are day in, day out focusing on stock price movements. They don't add any value, okay? So they prefer just trading volatility. Now, so the question is, how do you get rid of this risk? How, okay? Now you think about it. So for a call option, when the stock price goes up, your call price goes up, yeah? So what they do is they will say, all right, let's try and hedge this by shorting some stocks so that when the stock price goes up, the P&L of this will go down. Okay, sorry, stock price goes up, call price goes up, okay? So they try to hedge that by saying, I want to do something so that when the stock price goes up, I actually have a negative value. And when the stock price goes down, the call price goes down, but my position will go up. So on a net basis, they want to hedge this so that they become what we call market neutral. Okay, now they do that on purpose. They do that on purpose. So in essence, a CB hedge fund will always buy the CB and they will short some stocks, which means, and sometimes they also want to all right, so that means, so you buy the CB, you have credit risk, but you also have a call, okay? And if you break that down, so you are going to run a risk on the stock price, and you're going to run a risk on the volatility, and you also have credit risk, like I said, okay? Now, if you short some stocks, and I'm sorry about all these symbols here, then what happens is these two will offset each other, and you are left with just the credit risk and trading the volatility. And maybe you even want to get rid of that, which you can by using, thank you, a derivative called credit default swap. You can do that too, okay? My point to you is simply this. When you buy an instrument in the market and it comes with all these risks, risk A, risk B, risk C, risk D, and you are only interested in trading this one, then you try to get rid of all the other ones. And that's precisely what the hedge fund managers are doing. Okay? Are you with me there? So yeah. Interest rate. Yeah. You can hedge that too. Now, the problem is if you start hedging the credit risk and the interest rate risk, you end up hedging everything. There's no point even doing it. Okay? But the major component, because it's the most volatile, is the stock price. Okay? But Gloria, you're right to point that out. Okay? But the key component that we have been focusing on is the stock price. Yes? Yeah. Okay. So that is CB trading in a nutshell. Okay. Now I can actually just quickly show you these points. Hedge funds trade the volatility. They don't care about the direction of the stock price. They don't care whether it goes up or whether it goes down. Okay. Now, for you to be able to do that, if you want to hedge a long call, because when the stock price goes up, the call price will go up. So you want to have a hedge that when the stock price goes up, you actually make a loss. So that when the stock price goes down, and your call price goes down, then you are protected. In the end, you are hedged, okay? Now, just remember, this is how hedge funds trade CBs, because unless you understand that part, a lot of the talk that we've been having will be lost on you, okay? Um, no, 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 no. The volatility is the parameter that you use to price your options. Is this input here, okay? Let me just quickly take you through, because we don't have enough time. I'm so sorry, okay? And I wouldn't want to stop you going to that seminar at 5:30. I know you had a busy day today, but just very quickly, I want to go through with you that Country Garden transaction, because it is quite a classic trade that people still talk about even to this day. Now, here is what happened. So you have hedge fund, and like I said, they like to buy these CBs, but what they normally do is they would turn around and they would try to borrow shares from someone, let's say investor X. They would try to borrow shares, and then they will sell these shares in the market. Now that is a classic short selling procedure that you follow, and this is how hedge funds trade CBs most of all. Okay, so that is why being able to borrow shares is so important for them. If you issue a CB and you try to sell it to a hedge fund, and the hedge fund guy asks you, is it easy to borrow this stock for short selling? They will ask that question. And if your answer is, it's quite hard, or the cost is quite high, okay, the cost of borrowing. So either they will say, all right, no interest, or if they are interested, they want compensation for the difficulty, okay? And earlier, when I gave you that table, okay, so when I say that if the stock borrowing cost is very high, investors would want a higher coupon, so there's a positive correlation. That is the reason, okay? So when it's very hard to borrow a stock, then investors don't like it, or at least the hedge fund community, they don't like it. And either they say, okay, I'm walking away, or I want more compensation in terms of coupon. Now, this is normally how a hedge fund would trade a CB. In the Country Garden case, ideally, what you want to do is the hedge fund will buy the CB from Country Garden, and they can borrow shares from Country Garden here. Country Garden will lend them the shares that they can short sell in the market. Here is a short sell. And issuers, normally they actually don't mind, because they know if you are a hedge fund and you want to invest in a CB, you are going to short sell anyway, with or without me. They know that, okay? So sometimes, quite happily, they would buy the shares. They would buy the shares from the market and lend them out, okay? This is MKT. Now, in the case of Country Garden, they were not able to do that because there was already not enough shares in the market, in the public float. If they buy some more, there will be even less available in the market. So they were not able to do that. But ideally, you want to do that. There's a name for this technique. It's called delta exchange or delta repurchase. that is when the issuer, you don't have to know that, okay? When the issuer is providing the shares to the hedge fund for them to hedge their delta, okay? It's called delta exchange or delta repurchase. This is not what happened, okay? And I already explained to you why it didn't happen. This is what happened. So Country Garden couldn't stand there and provide the shares. So they asked Merrill Lynch to help. So Merrill Lynch could buy shares from the market, and then they buy the shares from the market and then they lend them to the hedge funds. Okay, now there's a problem. If Merrill Lynch is going to buy all these shares, so Merrill Lynch will have an exposure. Merrill Lynch will be saying, well, why should I take the risk of buying all these shares? So here they are just lending, they're not selling. So when you buy these shares from the market, you are running the risk of Country Garden share price, okay? So they did that, and what they did was Country Garden said, all right, I understand you bought these shares in order to be able to lend them to the hedge funds, and thank you for doing that, and I understand you need to hedge yourself. How about we provide the hedge for you? Okay, so that means when they buy from the market, they are long, and when they turn around and they face Country Garden here, they are short, and they are short because Country Garden is long. Now, here is the billion-dollar question. Country Garden took a position on its own share price. That is the essence of it. Country Garden took a risk and took a position on their share price. So they went long so that Merrill Lynch can be short here. So they're long. So now Merrill Lynch is neutral because they are long, buying from the market. They are short. Now, how did they go short? How? They did this via what's called an equity swap. You might wonder, what is an equity swap? Now, I actually explained that in an earlier set of slides. Okay? Now, an equity swap is basically an equity derivative which would allow you to take an exposure in some stock markets. Okay, the way it works is if you are, let's say you are Country Garden, and I am Merrill Lynch, then in this swap transaction, what Country Garden would do is they will pay the borrowing stock. So let's say you trade $1 billion is your notional principal. So they will pay the LIBOR funding cost on $1 billion. And what they will get, number one, they get the dividends and they get the appreciation. So if $1 billion, if there was a 10% return, that would be, then that means Country Garden will receive 100 million from Merrill Lynch. Now, unfortunately, if the stock price of Country Garden drops, let's say it drops 30%, minus 30%, that would be a $300 million loss. So Country Garden would have to pay Merrill Lynch $300 million. Now, this was what really killed them, because the share price of Country Garden just kept dropping and dropping and dropping. I think the lesson from a story like that is even if you are in charge, even if you are the owner, okay, it doesn't mean you have all the answers on your company's share price. There are things beyond your control, and you can also get it wrong. Okay, that's what I found. Okay, so that is the equity swap. I wanted to, and if you understand this, then you can understand how this works. Okay. The only other thing I want to just quickly go through is the call spread. Okay, and I have written some notes here. I think they are quite easy to understand. So I'll show you the diagram. Okay. So you have an issuer. Let me just wipe out all this scribbles. Okay. So you have an issuer, and they issued a CB where the conversion price might be 125. Okay, but they don't really want to sell their shares at this price. They would prefer to sell it at a much higher price, let's say 150. Okay. But the problem is no one is going to be interested to buy a CB where the conversion strike is so far away. So what you do is you trade what's called a call spread. And the call spread is this one here, where you buy this option, but you sell this one, and you trade that with an investment bank. So when you look at the entire picture, when you add everything up, so this one will offset this one. So when you look at the whole package, it would be as if you have issued a CB with a conversion at 150. Okay, that's the call spread. All right. Maybe you're wondering, why don't you just go out there and you issue a CB with a conversion of 150? Well, as I told you, you just can't, because no one will be interested to buy that. Okay. Absolutely, you are absolutely correct. Okay, you can try to pay a really attractive coupon by issuing something like this, but still investors may not be interested. Okay, so it's a constraint optimization exercise. Okay, in the end, I just want to make a mention of this in case. You know, you can read the Microsoft case because that talks about this, you know, in quite a lot of detail. Okay. Now, so I wanted to do a quick recap on the CBs. We have done that. I wanted to share with you how hedge funds actually trade CBs. We've done that. I want to talk about what a call spread is. Okay, we've done that too. We've talked about an equity swap and what that means. We discussed the Country Garden transaction, and a lot of people in the market know about this, so it helps. And I think, you know, the derivative engineering behind it, you know, is very elegant. Okay. Unfortunately, they lost money. Now I want to, and there's a table here. This is just a summary of the things that Rose Kay was discussing with you in class. Okay, so I put that down here. The last part, last but not least, okay, I want to give you a preview of how you can prepare for your midterm. Now, I want to emphasize, I'm not telling you what's in the midterm, okay? I haven't seen the paper yet, but I have here a list of what I call concept checks. So if you diligently go through these and you are comfortable that you know what's going on, okay, I think you'll be okay. But always remember the three golden questions, okay? So the what part, what is something, why are we doing that, and how do you do it, okay? And you see what I mean. I'm going to show you now for equity markets, for IPOs. I think this is the minimum list of things you should know, okay? I'm going to make these slides available to you tonight on Blackboard. I was making some last minute changes, but you will have them, okay? So you should by now, because all of these actually are in Rose K's notes, and also she wants you to listen to her in class and make sure you're paying attention, okay? What does clawback mean? You should know what is public float, what is green shoe, double dip, okay? Now, I spent a lot of time making up this list. I'm not saying that you're going to get a grade A just because you know all this stuff, but it would be a good start, okay? So everybody will have access to this. For follow-on offers, you should know why people do that. What is the motivation? What is the takeover code? It's the creepers rule, okay? What are these things? Now, we discussed this last time, if you remember, okay? Jackie, this file will be available to you, okay? But take a picture of it if you want to, okay? So rights issue, open offer is not so common, okay? Follow-on offer, second page. What are the factors that can affect the size of a follow-on offer? For example, you know, the average, what is it, ADTV, average daily trading volume, okay? TV is not television, okay? Trading volume. Name two types of preemptive follow-on offer. Well, I can already tell you now. It's the open offer and the rights issue, okay? Stuff like that, okay? I really think this should be quite helpful for you, okay? If you still can't do it, guys, I've tried my best, okay? Debt capital markets, bonds versus equity, you should be able to tell me, you know, the pros versus the cons of each market. Bonds versus loans, you should know they are very different, okay? Different types of bonds. What are bulldogs, Yankees, Iran or whatever, okay? Hybrid securities, like COCOs, bond trading, impact of withholding tax. I don't know if Rose covers this part, actually. Huh? Maybe not. Okay, so don't worry about that. Okay. Contractual versus structural subordination. If you see something which didn't get covered, okay, then just ignore it. Okay. Keep what agreements, well, you do know that. Okay. Sukuk. Yeah, we talked about that too. Okay. Did I talk about the Sukuk with you? Last time we did, right? Yeah. Now, this is equity link capital markets. I'm going to finish soon, okay? So on CBs and other related instruments, pros and cons, who is in that market, like I said, number one participant, hedge funds, okay? And then also understand how they trade it, which we discussed today. What is a call spread? And what are the key drivers of option value? Now, I know you haven't done the derivative course, but you don't really need to. I already told you just now by showing you this screen here, for example. Okay, and some of these things, okay, investor put, tax call, how do investors hedge the credit, especially, by the way, I guess I can qualify this, how do hedge fund investors, but they are such a big part of the CB world, okay? And why is it important that I guess you can have the same thing. Hedge fund CB investors should be able to short sell the underlying shares. Okay, I told you about that too. And I guess the most important thing is the session today is recorded, so it will be on video. It will be released to all of you later on. It's only an hour long. Okay, I shouldn't say only. You can watch half a movie in an hour. Okay, but if there are parts you don't understand, you can go back, and I hope it will be helpful for you. Okay, so today we talked about all these things. We talked about CB and how hedge funds trade that. We talked about the country garden case, which involves you understanding what an equity swap is. And we spoke about call spreads. We talked about, we had a concept check, and I know that will help you. And we also talked about the logistics, didn't we? So tomorrow will be first time with Christopher Lee. Next week will be the midterm, starting 10 a.m. I will confirm the venue with you shortly, okay? And Jan 26 is when we start the presentations and the cases. And the first two cases will be Ant Financial and Amaranth Advisor. Everybody will take a quiz, and 2 teams or 4 teams will be presenting. One final thing, all right, which I guess I must tell you. If you go to Blackboard right now, I mean, don't do that, but if you do, there is a document listing your name, your tutorial, which hasn't changed, your class, and the team that you belong to. Now, I'm sorry this document has been changing every day, sometimes 2 times a day, but never mind. So this is by alphabetical. If you scroll forward to page 4, I have resorted it by project team, FA1, FA2, FA3, and if you scroll forward a little bit more, you see the seating plan, right? Sorry about the pink color, okay? I couldn't think of what else to put there, so I just put the first available color. Maybe you like pink color, okay? So if you are the same color, you are in the same team, okay? Now, please sit where you have been allocated a seat, which means what? Please don't come to the wrong class. Please don't do that, okay? People will start asking, well, who are you, okay? This is my seat, okay? And don't think you can sit here either, okay? Chris Lee will come around and say, oh, who are you, okay? Aren't you from the afternoon class? Aren't you from the other class, okay? So please don't do that, okay? I might have told you already that part of the quizzes that you do are group quizzes. So the whole group will tackle a few questions. So if you are from FB and you come to the A class, who are you going to work with? Okay? I don't know how we're going to give you points. Okay, so try not to do that, please. All right. I wish you a very good evening, and I hope that you will have fun if you are going to that seminar with Mr. Tom Morrow. Okay. I better let you go now. And thank you and have a nice evening. Okay?